let's talk macroeconomics, the Fed's decision, and yield curve uninversion with Campbell Harvey back with us, professor of finance at Duke University, director of research at Research Affiliates, of course, author of Yield Curve Inversion Analysis, which I was refreshing on last week. Cam, welcome back, because everybody was saying the yield curve inversion never brought us recession. Don't listen to the yield curve uninversion either. You got an answer to them, right?
Yeah, so it turns out over the last 4 recessions, the yield curve uninverted before the recession actually begins. And this is kind of a natural property of a leading indicator. So you get an advanced signal well in advance, and then the signal turns positive and a recession starts. Now, to be clear, what you're talking about is a particular piece of the yield curve.
Correct.
The 10-year month, 2-year.
Correct.
But the original research that I did for my dissertation
3-month
prefers looking at the 10-year minus the 3-month.
That's
so
still
very
inverted.
Short term. That is still inverted. So it has been inverted for quite a while, 22 months. The longest historical inversion is 23. So we're very close to the longest historical inversion.
Campbell, so 2 interesting things there, and sorry to have to bring you back to your dissertation days, but I love this talk, and I feel like there's still a lot of kind of misunderstanding the way people portray it. So the fact that you use the 10s to the 3 months, which are still deeply inverted, does that then perhaps suggest that we could kind of go on treading water for a little bit? Because according to your study, when that one uninverts, right, that's when the recessions are hitting.
Yeah, just to be clear, there's a lot of correlation between the 10-3 and the 10-2 years. I prefer the 10-3 for a simple reason. It's got the longest history. And also the 10-2 year had a false signal in 1998. So my metric doesn't have a false signal. But I do think that we need to look at this in the larger context. There's other information that is pointing to a slowdown. So in particular, if you look at the employment situation, if you look at year over year non-farm payrolls, that has been decreasing very steadily. The number of openings to unemployed has been decreasing. There's still some way to go, but the vector is pointing towards slowdown. And the ideal scenario is a so-called soft landing recession, and that's a very mild recession. And we've had a few of those. So 2001 is an example of that, where you get very slow growth. It's called a recession, but it's short and it isn't really painful.
Cam, this is to come back again, not to belabor the point, but what do you think is creating the gap right now between the 10s to the 2s versus the 10s to the 3-month? Is there that much aggressive assumption of hikes in the market that the 2 years uninverting, but the actual more Fed-controlled 3-month needs to see the cuts actually happen? Is that why that's still so inverted?
You are correct. So this is purely a result of the Fed keeping the Fed funds rate too low for too long. So it's even, to me, shocking today. The Wall Street Journal's got a headline that the shelter inflation, even though the overall inflation dropped to 2.5, the shelter inflation will give Fed pause.
I know.
So that
I read that. I said Campbell's going to hate that.
Yeah, so they might not cut by 50 basis points, but only like 25. And this makes no sense whatsoever. Just look at the real-time data. Look at apartmentlist.com. So their year-over-year rentals minus 0.8%. So negative growth. If you look at Zillow, it's about 3%, which is far below 5.2%. If you look at the median house price reported by the Federal Reserve, that is negative year over year. So the 5.2, where does it come from? It doesn't make any sense. So if you put any reasonable number based upon real-time data, the inflation rate year over year is less than 2%. So we are well within the Fed's range. And given the negative vector that employment is on, it's time to act. And it's time to act with decisiveness, not this drip, 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 25 basis points. We need to head this off, because when the Fed makes a change, that doesn't instantly impact the economy. There is a lag. So the Fed needs to look forward, and it can't afford to wait too long. They made that mistake when they labeled inflation as transitory, and we paid a heavy price for that mistake, and we're still paying for it. So I think that the Fed needs to lead, and that means a 50 basis point cut.
You think 50? It seems, by the way, the market has been warming up to your idea. I've kind of been warming up to it as well, to do a bigger cut, just because the relationships in the market seem to be pretty convincingly pointing towards the need for some support, given what we talked about in bonds in particular. Okay. Point made on the housing. You're also reminding me I need to write a strongly worded letter to my landlord on their pricing negotiations for my next lease. Everybody should take note of that, by the way. So Cam, what then comes next in your mind? When you say employment's on a vector, that mathematically is something that continues. So if 25 is not enough, then does that vector extend to what? Are we talking 4.5% unemployment by the end of the year, or what?
Yeah, so this is how it plays out. So if the Fed keeps the rate, the short-term rate high, what that does is it reduces growth in the economy. And it's kind of obvious why. It's more expensive to invest. So a company that is thinking of a new investment project, they're going to think twice, given the cost of capital is so high. And so this holds back economic growth. And when you hold back economic growth, that means you hold back employment growth also. So what the Fed needs to do is to start moving the rate to the level that it should be right now. So given the inflation dynamics and given the employment growth dynamics, I don't think it's reasonable to think that a rate of 3.5%, that sounds about right to me.
Okay.
Yet we're way above that.
So we need 100 bips
even
plus.
50 basis points, that's not enough. So we need to move towards a 3.5% rate, and the faster we do it, the better. And that will potentially save a recession that nobody wants.
Understood. Love the macro analysis. Like the fresh take, Cam, with the data today. Also like the clarity on the curve. I described it as the inversion is like a prognosis, that something's sickening underneath. When you uninvert, that's when the worst effects start to show up. So that's basically what we're looking for now, once they hopefully try and get ahead of that, because 10s, 2s uninverting, your 10s 3 months probably on the way pretty soon.
Exactly. So just think of it. When the Fed raises the rates, that will flatten the curve. So it's very straightforward.
Yeah.
And I would like them to basically get it over with. All the suspense doesn't make any sense. The Fed says, oh, we're data driven. Well, okay, fine. That makes sense to me. But you should be driven by real-time data.
Yeah.
Not some construction of CPI that uses stale, sheltered data. So the Fed needs to be making decisions based upon real-time data, not data from 1 year ago or 18 months ago.
Okay.
That doesn't make any sense. And that sort of mistake is very costly for economic growth, and we will see the consequences.
All right. Cam, thank you for the catch-up, sir. If you were in the chair, though, you got to worry about November, too. Probably not a great look to do something crazy, unfortunately. I empathize with that for Powell, right? He's got to make this decision right before a big election. Cam, thanks a lot for the analysis. Appreciate your time. Campbell Harvey, professor of finance at Duke University and director of research at Research Affiliates. Good stuff on the macro.